Hey, check out the new billboard across the street. They got sales on jet skis. I've always wanted a jet ski. What do you need a jet ski for? You don't even live by the ocean. Well, I've always wanted a jet ski. To keep in the driveway and make the neighbors jealous, obviously. You think I could get a loan for it? Well, probably, but there's some things you should know before getting a loan. Whatever, man. I'm doing it anyway. Hello? Jet ski place?
The Finance Geek.
Let's say you find something that you want to purchase. Hopefully it's something that's a good investment and not just a reaction to a billboard advertisement. There are some bigger purchases that you might not have all the money you need to pay for it, like a house, for example. Well, that's where a loan comes in. And there are some things that you should know about a loan. A loan is where you borrow money from an institution, usually a bank, with the promise to repay the amount that you borrow back in an agreed amount of time with interest. Then you can use the money to make the needed purchases. Think of it like if you want to cross a body of water with your car. You get in a ferry. You can't get across the water alone, so you borrow the ferry by getting on it. And then you pay the cost to use the ferry, which is kind of like interest. And if you don't have the money, well, you might have to clean dishes. Now, there are two main types of loans. The two types depend on collateral, or what you give to the lender if you can't pay back the loan. The first type is called an unsecured loan. This type of loan is less common because this is where you get a loan without having anything to give back to the bank for collateral. This is the hardest type of loan to get because it's viewed as the riskiest. Think of it as letting your neighbor borrow your shovel. Although you may get it back, let's be honest, you probably won't see that shovel again, and it will go into the borrowed purgatory. The second type is called a secured loan. This type of loan is more common because there's something that's tied to the loan that the bank will get if you cannot pay them back, like a mortgage and a house. Think of this like instead of just letting the neighbor borrow your shovel, they agree to give you their firstborn child if you don't give it back. Chances are they'll give it back, or they might get a call from Child Services. Now let's talk about what to look for in a loan. So let's focus on a mortgage because this is going to be one of the more common forms that you'll see. With a loan like a mortgage, there are a couple parts that you should look at. First, the interest. This is how much extra you'll pay to the lending company, as long as you owe them money. This can be called the APR, interest rate, etc. What it comes down to, though, is it's the cost of borrowing the money. Therefore, you want to pay as little extra as possible. Think of this like when you get fries at a restaurant. This is the amount of fries that your significant other takes to taste because they bought the fries this time for you. Make sure you can save as many fries as you can. Now the second thing is the down payment. Some loans require you to pay a lump sum up front.
Thank you.
This is in some ways to show that you're serious about repaying the loan. The amount can vary on the loan, but usually there is something. See our video on preparing how to buy a house. So make sure you have an amount of money you can use to get the loan. There are other important things that you should know about a loan, especially for a mortgage. The first is the time frame or the term of the loan. This is how long you agree to pay on the loan. A big misconception is that you want to get the shortest term possible, to pay it off as quickly as possible. But here's a trick. The banks actually use the term to calculate the repayment. As long as they allow prepayment of the loan, that does not mean you have to wait the full term to pay it off. For example, if you get a 30-year mortgage, a 30-year mortgage is designed to be paid off in 30 years. But if you pay extra money towards that mortgage, then you can potentially pay it off faster than 30 years. So if you intend to pay it off quicker, it's generally better to get a longer loan. Think of this like a car ride. If you plan a car ride based on a speed limit of 30 miles per hour to get to grandma's, but then you go 50, you'll get to her house much faster, just in time to help clean the gutters. So the other thing you should think about is the type of loan. This is determined by how the interest is calculated and applied. There's fixed, there's variable, and all other kinds of loans. Generally speaking, you always want fixed. So you always know the amount of interest you have to pay. Think of it like playing golf with your buddies. You want to make sure it's a fixed number of holes. That way you can pace your drinking, Otherwise, you might be half conscious, sunburned, texting your ex-girlfriend that you love her on the 36th hole. It's only supposed to be 18. That's our show. Thanks for watching. Now remember, if they say they don't want fries, they do. That's our show. Thanks for watching. If you enjoyed this video, please consider following. And if you think we can assist you in any of your financial endeavors, please feel free to contact us. Our information is in the description below. Thank you, and we'll see you next time.